Welcome to Friday Takeaway. This week the market had a little bit of a meltdown, so we are looking at some long-term ponies in the form of Nestle and Lehong. But speaking of that meltdown, almost every single major stock market in the world saw a rout towards the end of the week, starting with the Dow Jones seeing a particularly steep sell-off on Wednesday. This first tripped up markets in Asia, the Hang Seng Index dropping almost 4% in afternoon trade on Thursday, with Shanghai and Nikkei not faring any better, followed by Europe, with tech stocks in particular taking it hard. But the thing is, nobody can seem to actually pinpoint the reason for it. Some have said it's the ongoing trade war, but that's been going on for months. Others point the finger at a jump in long-term interest rates, but some say it's just the market undergoing a correction after months of record gains and people are just sort of rushing to book profits. Now for the Dow, the sell-off actually continued on Thursday. The market closed 2.1% down. All three major indices in the US lost more than 5% this week. But the futures indicate that a possible rebound might be on the cards as the week ends. Now, US President Donald Trump, however, has said that the Federal Reserve has gone crazy for continuing to raise interest rates in the face of market turbulence, and even going as far as saying that the Fed has gone loco. Of course, you then had a whole bunch of people calling it rubbish, which is par for the course with this president, to be honest. JP Morgan's international chairman, Jacob Frenkel, said of course the Fed is not crazy. The rate hikes have been planned and it's not up to the US president to make such statements. While IMF's MD Christine Lagarde said she would not associate Fed chairman Jerome Powell with craziness. He comes across as very serious and solid, which is what you really want in a central banker, to be honest. The rout inevitably affected the KLCI, which on Thursday fell below the 1,700 point mark but clawed back some gains to finish above that. Today all seems calmer, but there is still this undercurrent of wariness. But there were some local factors that played their part as well. The first is following the massive New Dawn conference, where the government made it clear that Malaysians might need to expect new taxes and possibly more taxes from the government as it seeks to right-size its finances. Also, with less than a month to go until Budget 19, it is beginning to sink in that there will be more pain ahead before any pleasure, and that indication is that the investment community should not expect any goodies. But the government has made it very, very clear that the country is not in austerity mode. So when markets go around the bend, this is the time to bunker down in industries that most regard as long-term and defensive. One of which is consumer, because after all, people have to eat, don't they? So this week we take a look at two consumer stocks at two drastically different price points. We will take a gander at Lehong, which is a livestock farming company which has had some share price weakness but have solid expansion plans in the coming months. And way at the other end of the spectrum is consumer giant Nestle, which is poised to welcome a new CEO and recently sold some of its businesses. So let's take a look at how they match up. Lehong is an integrated livestock farming company. It is best known for chickens, whether it is chicken eggs, chicken parts, liquid eggs, and even processed-related chicken products under brand names NutriPlus and Wise Choice. One of its major shareholders is Japan's NH Foods, and the company has a retail presence, in fact, in Sabah through its Gmart brand. Its latest results for the first quarter of FY19 were not good. Net profit dropped almost 50% to 2.3 million ringgit, although to be fair, revenue did go up by 8.9% to almost 200 million ringgit on higher sales volumes and selling prices. But the big culprit for this discrepancy is the higher than expected feed costs, especially for soybean and cornmeal, coupled with lower than expected table egg prices. This, and I mean the feed cost, is of particular concern because according to UOB, 1% increase in feed costs actually reduces earnings by 4 to 5%. This has affected share price, which has been noticeably dropping over the past month and is currently trading at around 52-week lows. So on average though, the stock has been trading around 90 cents. So Lehong has two new plants in the pipeline, and there's a JV plant in Pulau Indah that is due to come on stream on November 13th. This is followed by the completion of its pasteurized liquid egg plant in Johor by the end of this year. All of this, by the way, is because the current plant is already fully utilized. A good problem to have. And let's not forget that Lehong also has NH Foods in its corner. The collab between them will result in increasing contribution to profit before tax from less than 5% now to about 16% by FY21. Three research houses cover Lehong, and two of them, namely UOB and Kenanga, have buy calls. UOB has a target price of 76 cents. Kenanga's target price is more lofty at 1 ringgit 13. The only contrarian to this bunch is Hong Leong, which downgraded its call on Lehong to hold after the 1Q results and cut its target price to 55 cents because while it acknowledges that the expansion plans are good, it feels it'll be a while before the numbers get better. Now, who doesn't know Nestle? It is the largest F&B manufacturer in the world with headquarters in Switzerland. There is no chance that you haven't had anything from them throughout your childhood. Their best-known brands are Milo, Maggi, Kit Kat and Nescafe. So earlier this week, Nestle announced that it was selling its chilled dairy biz and ops to Lactalis, a French company that is the world's largest dairy firm, for just over 155 million ringgit. Given that this segment only contributed about 2% to total sales, the impact on earnings is expected to be tiny. And analysts in general are giving this deal a thumbs up, because MIDF says it is positive on this move because the segment outlook is expected to be challenging. And something else to note, for FY17, revenue for this segment dropped 8.6% year-on-year. So part of these proceeds will actually go to upgrading Nestle's Milo plant in Chembong, which will help with efficiency and capacity. This will also result in the plant becoming the biggest Milo manufacturing center of excellence, and that's those words, in the world. Also come December, Nestle will also have a new CEO in the form of Juan Aronols, who will take over from Alois Hafbauer. The stock is expensive, so it's not an easy buy unless you have very, very deep pockets. Aside from that though, the upcoming quarter is also expected to be very subdued according to analysts, because there is this transitory period after the end of the recent tax holiday as people's buying patterns adjust. Most of the research houses, 7 to be accurate, all have either sell or underperform on Nestle, with target prices ranging from 97 ringgit and 40 cent to 129 ringgit from all of those who have those sell calls. There are two holds though. MIDF has a target price of 133 ringgit and 60 cent, and TE Securities, which actually upgraded its call recently from sell to hold with a higher target price of 162 ringgit. Nestle's share price has always been fairly steady as a rock, and that doesn't look like it will change, but it has seen a 45% increase since the beginning of the year. Its 12-month dividend yield, just to note, is 1.87%.